Hello and welcome to Unit 1, Lesson 5 within Eagle Academy Trading. In this unit, we'll be covering the best practices when it comes to investing. This lesson will provide you a basic rundown of some of the best practices to have when it comes to investing, and these tips can help point you in the right direction as you get started. Let's get started. When it comes to investing, make sure to try to start investing as early as you can and keep in mind the concept of compound interest, which I referred to in the first lesson, as you are able to start off very early. And if you're able to save a lot more month over month or year over year, then you're able to grow your account much larger. Understand your own goals and objectives and audit your own personal finances. Understand where you are personally. Make sure, for example, one thing that's good to have is an emergency fund, which can cover you for 9 to 12 months. Try to potentially to save money for that. Just put in cash, for example, or something very safe, an investment that's very safe, while you put you might have more of a speculative portfolio and more of like a retirement portfolio. So try to understand your own goals and objectives when it comes to managing your personal finances. Another concept to understand is bag holding. So say, for example, you're holding a stock and it's been doing nothing over the past year or so, it's just been selling off. Something that some investors do is sell those positions, especially if those catalysts that you were looking at when you initially created the position no longer hold, and your investment thesis or investment understanding is not the same as you believed it would be when you initially got into the position. Another common mistake when people start off is catching a falling knife. Many times individuals might see some of these smaller companies go down like 20 to 30%, and they might try to chase that bottom, but understand that there might be more selling going on. And based off that news, especially, for example, within like the small cap space, a lot of those names continue to sell off. So keep that in mind and avoid bag holding some of those, especially those smaller cap names. And make sure to have investments in spaces and products that you specifically understand. For example, if you're trading options for the first time, as a common practice is opening up a paper trading account or a simulated trading account so you can truly understand your potential risk reward when it comes to the trade, as well as just testing out different types of trading strategies as well. And try to find companies that you truly understand and potentially try to find them in spaces that you understand as well. Another important concept to keep in mind is risk reward tolerance. Understand that if you're taking larger risk, there's the potential for higher reward, but understand that when you're putting your money towards an investment, try to understand what's the max drawdown that you're willing to take, or what's the max loss that you're willing to take. And through that process, you might be able to find something that better suits your needs. So for example, say you need the money in within like 3 to 6 months, having like a short-term investment in US Treasuries or something safer might be more applicable to you. While if you're looking to get into the very speculative nature, you're willing to lose a majority of your investment, you might be looking more into like the small cap range while you're taking while you're investing in that potential risk for a higher reward. Now, an important concept to understand is beta. Beta is a measure of a stock's volatility compared to the overall market. It can be used as an indicator when it comes to analyzing risk and investment. And especially as you're starting off, you can look at the beta of your portfolio and compare it to, for example, the S&P 500 and see how much risk you're taking. A lot of times, portfolios are measured to a benchmark, and many times the individuals like to use the S&P 500 as that specific benchmark. Now, some best practices continue. Make sure to, when you're entering a trade, to double check your trade. Make sure you understand the order quantity and the price that you're trying to buy your individual stock or investment product at as well, to avoid any issues when it comes to fat fingering in terms of adding additional quantity to your trades, or just buying, for example, a call instead of put. When trading during extended hours, make sure to understand that fills will often be wider due to less liquidity. So say you're a trading company after hours, since it had like great earnings, make sure to understand if you're buying shares after hours, a lot of those shares will have a wider bid ask spread, meaning that you might not be able to get the best price. You might be not be able to get the best prices compared to when you're trading during market hours. Another thing to keep in mind is diversifying your holdings and avoiding having one particular name in your portfolio if you're trying to reduce risk. If you're holding, for example, a specific industry, or your portfolio is largely consumed in a specific industry or a specific name, there's a lot more risk you're taking based off of that specific company name or that specific industry as well. So keep that in mind, especially when you're trying, if you're trying to build a longer term portfolio as well. In conclusion, there are many aspects of to evaluate when it comes to trading, and understand your own risk reward tolerance, and take a look into beta as well, to look into the amount of risk you are taking compared to the overall S&P 500, for example.